win the $1 million in Bitcoin may very well double 1, 2, 3, 4, 5 more times. Bitcoin's the dominant crypto asset. Ethereum is the dominant crypto application. You can divide the entire universe into some segments.
As much educating investors about this stuff as it is about building infrastructure, because I think we're at a point in time where many investors don't know the difference between Ethereum and Filecoin and Solana. They just all see it as crypto, and you wouldn't buy stocks that way. So I think we need to focus more on what these tokens represent, what the network value is that is backing them.
Also, only a tiny percentage of my viewers are actually subscribed. If you enjoy the video, consider subscribing. It's free and you can always change your mind. Enjoy the video.
A much wiser course of action would be to borrow money against Bitcoin. If you have an appreciating asset, never sell it, finance it. And if the asset's appreciating at 20% a year, and if the interest rate is 5%, then it's pretty obvious what you ought to do is keep the asset, pay 5% interest, because the tax bill on money that's borrowed is zero. I'll make one more point. It doesn't make any sense to pay for anything in Bitcoin for two reasons. The first reason is because it's a taxable event. Mm-hmm. And you're a fool to accelerate taxes on your own person by a decade. The second reason it doesn't make sense is because it's a long duration asset that's deflationary, which means it's likely to go up in value. It's been going up 150 to 200% a year every year for a decade. So why would you pay $1 million in Bitcoin to buy something which is going to depreciate in value, when the $1 million in Bitcoin may very well double 1, 2, 3, 4, 5 more times? Bitcoin's the dominant crypto asset. Ethereum is the dominant crypto application. You can divide the entire universe into some segments, and Ethereum is competing with Binance Smart Chain and Solana. That's very competitive. They're very complicated. They're very centralized, much more centralized than Bitcoin. They have to be centralized because they need to run on proof of stake networks because they need the speed. Mm-hmm. So proof of stake itself is orders of magnitude more centralized than proof of work, because you don't have these sprawling networks of miners with their ASICs everywhere on Earth sucking up energy to keep any one person from getting control of the network. So Bitcoin is like the dominant winner of sound money. These other things, they're just very risky. They could crash, one could win, one could lose. Ethereum doesn't even run on proof of stake yet. So, basically you don't know when they turn on proof of stake, the entire thing's not going to go in some bizarre way, right? What'll happen? You don't know.
Interesting.
So, so let me say it a different way. If you're a crypto investor and you run a venture capital fund and you want to make investments with high risk, high reward, and you want to study it and you want to take the risk, then you can trade in those things. But in my opinion, they're 100 times less lucrative over time, and they're 100 times more risky. So it seems like it's a 10,000 to 1 difference. I wouldn't do it, but other people do it, and it's probably good for the industry because it markets the industry, right?
Right.
And they're venture capitalists. They have to do it. Like, I'm not gonna, I'm not gonna tell them not to do it. It's like this is one risk tranche. This is a different risk tranche. If you're super smart, and if you get, if you guess, will it be Binance Smart Chain or Ethereum, or maybe it's both, maybe you trade. But, when you get into that, you get this question of, well, when are you going to take money off the top? And when are you going to diversify? And are you going to be in it forever? I tend to think I would prefer to invest in things I can hold for a decade, if not 100 years. But there are plenty of people whose job is they're venture capitalists. And the venture capitalists are betting on things where they think there's a 90% probability it'll fail, but they think that they'll get 100x return if it hits. So it's a different thing, right? So I would say it depends on your portfolio of money. Like are you investing someone else's money, your own money? Are you a VC? Are you a private equity investor? Are you a saver? Converts their money into a strong currency. An investor manages a portfolio of risk. I buy some Apple, some Facebook, some Google. They've all got risk. A trader manages a portfolio of risk derivatives. I'm guessing, I've got options in Apple, and I think that Apple's going to beat on the next quarterly release.
Right.
It's not even a portfolio of risk over a decade. It's a portfolio of risk over 90 days. Or it's the second derivative of risk. I'm like shorting Apple options against Google options because I think the spread is coming in, and it's something you can do.
Right.
It's just a different thing, right? I'm arbitraging people's risk derivatives, and fine, knock yourself out if you're bored, if it's your profession. But another analogy is like a decade ago, if you bought Apple and Amazon and just held them, you probably would have made a lot of money. You would have made 10 to 20x your money. Now, if I could go back 20 years or 10 years, would I give people advice about when to buy and sell Apple in the year 2012? Or how to trade Apple options against Amazon? Should you buy or sell Amazon in the year 2014? Can you remember off the top of your head whether you should have bought or sold Amazon in 2015 so you could buy it back cheaper in 2016, or did it? Yeah. By the way, if you had, Jeff Bezos was at war with Donald Trump before the election. And so what's the worst thing that could happen to Amazon? You would think that it would be Donald Trump getting elected, right?
Right.
But if you had actually sold Amazon once you know that Donald Trump was getting elected, it would have been the most catastrophic decision in your life, because Amazon stock doubled in the first 12 months after Donald Trump was elected. Like, there's nothing you can buy that's better. So you're selling the winner to buy the loser. Let me make it simpler. If you owned a company in Venezuela, and the company sold anything, and you got paid in bolivars, mm-hmm. and you decided that, and you knew that the bolivar is going to keep falling at like 20-30% a year, and you roll the clock back 20 years. If you were unwise, you just keep working, and eventually your assets go to zero. And if you were smart, you would convert your cash flows into US dollars and put it in a bank in New York City. Now, when would you exit from the dollars in New York City and trade back into the bolivars in Venezuela?
Right. Unless if that became the leading currency in the world.
Well, what if the United States government said, well, you can do it tax-free? You're still not going to do it.
No, right, exactly.
Right? I mean, and that would be the case for any weakening currency in Argentina. And if you're in Zimbabwe, when are you going to exit your U.S.? If you basically bought, a New York City apartment and companies in New York City, and you're a billionaire in the United States, when are you going to sell all that and reinvest it back in Zimbabwe? You're not ever.
Right. So you would just
because the point is, one of the assets is stronger than the other asset. If Bitcoin is capped at 21 million for the next 1,000 years, it's only going to get more valuable, right? You can make more apartments in New York City. You can print more US dollars. You can create more houses on the beach. You can create more artwork, Give me something which is scarcer than pure monetary energy on the dominant global digital monetary network.